Many landlords spend a lot of time thinking about property prices. They focus on whether a property might rise in value over time or whether they are buying in the right area. But in practice, one of the most important parts of buy-to-let is often something much simpler: cash flow. Because property value may change over years, but cash flow affects how the property feels every single month. In this video, I'll explain why cash flow matters so much in buy-to-let and why strong cash flow often creates more stability than changing higher property values. Cash flow is simply the money left after the regular costs are paid. So if the rent is £1,300 per month and the mortgage and other monthly costs total £1,000, then the remaining £300 is your cash flow before tax. That number matters because it creates breathing space. It helps cover unexpected costs, void periods, and future maintenance. Without cash flow, a property may still increase in value over time, but it can feel financially uncomfortable to own in the short term. One of the key differences between property value and cash flow is timing. Property value changes may happen slowly over many years, but monthly costs happen now. Mortgages, insurance, repairs and maintenance all need to be paid regardless of what the property market is doing. This is why a property that rises in value but produces weak cash flow can still feel stressful to own. Value may exist on paper, but cash flow affects real life month by month. Strong cash flow creates stability because it gives the property room to absorb problems. If the boiler breaks, there is margin available. If the property is empty for a few weeks, the landlord is under less pressure. If mortgage costs rise slightly, the property may still remain manageable. Weak cash flow removes that flexibility, and when flexibility disappears, even small problems can start to feel much larger than they really are. A property might technically work on paper while still being too tight in practice. For example, if a property only produces £50 or £100 per month after realistic costs, there is very little room for error. One repair or short void period can wipe out several months of income. That does not automatically make the property a bad investment, but it does increase pressure. Stronger cash flow gives you more resilience and usually makes ownership feel more sustainable over time. Interest rates have a direct effect on cash flow because they affect mortgage costs. A property that once produced strong monthly surplus may become much tighter if rates rise. This is one reason why many landlords now focus more heavily on cash flow than they did in lower rate environments. Deals with healthy margins are more capable of absorbing changes. Deals with weak margins become exposed very quickly once borrowing costs increase. More expensive properties are not always better investments. In some areas, property prices are very high compared with the achievable rent. That can create weaker cash flow even if the property itself is desirable. Meanwhile, a less expensive property in a different location may produce stronger monthly income relative to its cost. This is why experienced landlords often analyse income first rather than assuming higher value properties automatically create better returns. Cash flow also affects how easily you can build a portfolio. Strong monthly surplus creates options. It can help fund maintenance, build reserves, and contribute towards future deposits. Weak cash flow makes growth harder because the portfolio constantly needs additional support. This is why many landlords prioritize properties that create stable income rather than relying entirely on future property appreciation. Income supports growth in a much more immediate way. Every property will eventually face some combination of maintenance, repairs, or void periods. That is normal in buy-to-let. The question is not whether problems happen. The question is whether the property can absorb them comfortably. Strong cash flow creates that buffer naturally. Weak cash flow means every issue immediately affects the landlord personally. So cash flow is not just about profit, it's also about how resilient the property feels during normal ownership. There is also a psychological side to cash flow. Properties with healthy monthly surplus tend to feel calmer to own. The landlord is less reactive to every repair bill or market headline because the numbers have breathing space built in. Properties with weak margins often create ongoing stress because the owner feels financially exposed. Over time, that difference matters. A portfolio should not only work mathematically, it should also feel sustainable emotionally. Over long periods, steady cash flow compounds. A property generating reliable monthly surplus for 10 years may create a more stable outcome than a property relying heavily on uncertain future appreciation. This is especially important in changing market conditions. Property prices can move up and down, but stable cash flow creates ongoing support regardless of short-term market sentiment. That consistency becomes increasingly valuable over time. One useful way to think about this is the difference between income and speculation. A property with strong cash flow works because of what it produces today. A property relying entirely on future growth depends more heavily on what might happen later. That does not mean capital growth is unimportant, but stronger investments tend to work even without optimistic assumptions. Cash flow creates a more grounded investment approach. A common mistake is focusing too heavily on the purchase price or projected future value while ignoring the monthly performance. Another mistake is underestimating realistic costs when calculating surplus. Some landlords also assume small margins are acceptable because they expect future growth to compensate. The problem is that weak cash flow can create stress long before any long-term appreciation happens. Strong deals usually combine stability with realistic expectations. A useful framework is to ask three questions. First, does the property generate meaningful cash flow after realistic costs? Second, does it still work if mortgage costs or maintenance increase slightly? And third, does the property feel financially comfortable rather than tight? These questions are often more useful than focusing only on headline yield or projected future values. They help bring the analysis back to real-world ownership. The key point is simple. Property value may create wealth over time, but cash flow creates stability along the way. Strong monthly surplus gives you flexibility, resilience, and room to handle normal landlord problems. Weak cash flow may still work in certain situations, but it usually increases pressure. The best buy-to-let deals are often the ones that balance long-term potential with strong day-to-day performance. Understanding cash flow changes the way you analyze property. Instead of focusing only on price or future growth, you start looking at stability, resilience, and realistic performance. And over time, those are often the factors that make portfolios more sustainable. This is the practical landlord.